Hi everyone, welcome back to another edition of the ACAP Recap, where we go beyond the blog and answer questions that we receive from either all of our listeners or from our clients and prospects. And today we're going to talk about the 1040, the Form 1040, which is the primary form that majority of Americans use to report their taxes during the tax year. Now, I say the majority of individuals because there are some other versions of the 1040, like the 1040EZ, the 1040NR, or the 1040SR, but we're not going to go over those because the majority of individuals use just a regular 1040 that we're looking at today. While looking at this form, it may seem a little confusing or a little intimidating, but I promise as we go through it and I explain each of the different sections, hopefully that will help clarify some of the mystique with the Form 1040. Now, when you're completing the 1040, you have a few options on how you can file it. You can either use a tax filing software, you can download the PDF from the IRS like I've done right now and complete it by hand or by your computer and mail it off that way, although very, very few people even do that. Or you can hire a CPA or a professional tax preparer to complete it for you using a professional tax software. I want you to think of the 1040 as a summary of all of your income from all the different sources that you receive and have that summation be on the 1040. So let's assume you have a full-time job where you get a W-2 income, you have some rental properties, you own several businesses, you own interest income. Each of those income sources is reported separately on different forms and schedules, and then the sum of those incomes is combined and put on your Form 1040. So let's assume you have a rental property, and with that rental property, you're obviously going to have rental income and you're going to have some expenses. All of that rental income and expenses is reported on what's called a Schedule E, which is separate. So on this separate Schedule E, you show all the rent you received, all your expenses associated with that property, and then you subtract your expenses from your income, and it comes out with a net profit. That net profit flows to your 1040 that we see right here. And I'm going to show you an example of that later on in more detail. So I'm going to break down the 1040 and we're going to go through each section individually. So for example, I'm going to go over the personal information section, the filing status that we see here. I'm going to define each of the filing statuses, the digital assets and standard deduction. I'm going to explain what those mean. The dependent section. So I will define what is a dependent and who qualifies as a dependent. We're going to go over each of these different income sources. Not each one of them. We're going to go over the major income sources. Next, we're going to go over the tax and credits and what qualifies as taxes and credits. Then we're going to go over the payments portion, and then the refunds and the amounts you owe. And then lastly, we're going to go over the third-party designee and what that means. Okay, so let's start off with the personal information part. This is pretty straightforward. It's your name, your last name, your social security number, your address. Pretty straightforward information. The only part that really trips people up or confuses people is the question where it's asking you if you and your spouse want to contribute $3 to the presidential election campaign. So the presidential election campaign lets you direct $3 of federal money to help publicly finance presidential campaigns. Now, while it doesn't change your refund or your tax bill, what it does do is it does allocate $3 of government funds, which ultimately comes from taxpayers, to support the candidates who agree to spending limits. Over the years, fewer and fewer candidates are using this program, but by checking the box, it's a way to support publicly funded elections and reduce the influence of large private donations. So next we're going to go over the filing status, and the filing status seems pretty straightforward, but it also confuses a lot of people. Now let's go through each status and who qualifies. The first one is a single status, and single, you would check this box if you're unmarried, you've never been married, legally separated, or divorced on the last day of the tax year. So if you are legally divorced on December 30th or December 31st, you are technically single and you would check this box. And also if you don't qualify for any other filing status. So for example, if you don't qualify for head of household or qualifying surviving spouse, you would click or check off that you're single. Sometimes people try to use this filing status even though they may be going through a divorce and it's not fully finalized yet, or they're separated and it's not fully finalized yet. But keep in mind, you're not able to file as single if you are still legally married or if you're still not legally separated. So the single filing status is only kept to those categories I just mentioned. It's also important to note that the single filing status is the least generous filing status after the married filing separately because it has fewer tax deductions and the tax brackets are narrower. So you would have to earn, it bumps you up into the next higher tax bracket faster than if you were doing married filing jointly or another filing status. So now let's go over what defines as married filing jointly. If you're married filing jointly, you're legally married as of the last day of the year. So on December 31st, if you and your spouse are married, then you are married filing jointly. And your spouse agrees to file a joint tax return reporting your combined income and your deductions. You can still file a joint tax return if your spouse died during the tax year and you did not remarry before the year end. So that's important to note. But you cannot file married filing jointly if you were legally divorced or separated on the last day of the year. You also cannot file married filing jointly if your spouse chooses not to file if your spouse chooses to file separately and is not willing to sign a joint tax return. So even though you may be legally married and your spouse does not want to sign a joint tax return, then you have to file married filing separately, which we're going to go over next. But if your spouse does not agree to sign that tax return, you cannot file a married filing jointly tax return. It's also important to note that married filing jointly is the most generous filing status because it has the highest deductions and it has the the broadest tax brackets. So you can earn a lot more under the married filing jointly status and be still below a certain tax bracket. The next category, which is pretty common, is the married filing separately. So you're entitled to this if you are legally married on the last day of the year and you and your spouse choose to file a separate tax return. So this is ideal for couples who want to keep their finances separate or spouses who don't want to be responsible for another person's tax liability, or in a situation where one spouse is not cooperating with filing a joint return. Those are instances where married filing separately will come into play. Now, married filing separately is actually very complicated. It's very difficult because especially for people who live in a community property state like California. And I'm planning on doing a whole separate video on this subject because it really throws people off. And if you live in a community property state like California and you do married filing separately, it's not as simple as you think, where you just file separately, you report your own income, and you go off on your merry way. It's actually more complicated than that. The next filing status is head of household, and this is a special filing status for unmarried taxpayers who pay more than half of the cost of maintaining a home for either themselves and a qualifying person, like a child or a dependent relative. Now, a head of household usually offers a higher tax deduction and better tax rates than filing single or filing married separately. But to qualify as head of household, you must have a qualifying dependent living with you and pay more than half their expenses during the year. The only exception is certain parents. The parents do not have to be living with you. As long as you provide more than half their support, you can still claim them when you do head of household, even though they don't live with you. The next filing status is qualifying survivor spouse. This is also known as a qualifying widower. It's a temporary filing status that allows you to file as a widow or a widower to use the same tax rates as a married filing jointly for 2 years upon the spouse's death, right? To qualify for the surviving spouse, you must not remarry during that 2-year period, and you must have a dependent child and pay more than half the cost of maintaining the household for that child. Now, this status provides a lower tax rate and a higher tax deduction than if you were to file single or head of household. The last filing status, the non-resident alien, is not going to be covered in this video because it's very complicated for non-residents and it's way beyond the scope of this video. Okay, the next section we're going to cover is digital assets and the standard deduction. So digital assets, this question first appeared on the 2019 1040, but it was buried in like a different schedule and not as prominent as we see here on the front page. But in 2020, they put it on the front page of the 1040 because the IRS wants to know who is transacting in digital assets. Because most people don't realize that digital assets are actually taxable. In fact, I did a very detailed video on this subject on the taxation of digital assets. So I'd recommend you go check that video out. But because most people are not aware that digital assets are taxable, the IRS decided to devote a pretty valuable space on the 1040 to ask people this question to make sure that individuals are in compliance with the reporting of digital assets. So digital assets would include cryptocurrencies, stable coins, virtual assets, really anything that's digital, that's an asset that's become very popular in the past few years. That's what classifies as a digital asset. And if you notice, the question is asking if you received any digital assets, if you sold any, exchanged, or otherwise disposed of any digital assets. So if you had really any interaction with digital assets, they want you to say either yes or no if you did have any exposure to digital assets during the year. Okay, so now let's go to the next section, which are dependents. And a dependent is someone you can claim on your tax return because they rely upon you or for financial support. Now, this includes a qualifying child, such as a son, daughter, a foster child, a sibling, a step-sibling, niece, nephew, grandchild who lives with you, meets the age and support rules. It could also be a qualifying relative, like a parent or a family member who earns below a certain amount based on the IRS, and you support them by providing more than 50% of their living expenses. Now, someone is not a dependent if they provide more than half of their own support. So if someone's living with you, such as a child or a parent, and they're fully self-sufficient, you don't provide any, or you provide support, but not more than 50% because they earn too much money, they are not considered a dependent. You'll notice on the dependents category, when you put their name, their full name, their social security number, their relationship to you, there's also two checkboxes. One is for the child tax credit, and the other is for credit for other dependents. So the child tax credit is a tax benefit for parents and guardians to help them offset the cost of raising children. In 2024, the credit was up to $2,000 for a qualifying child under the age of 17 at the end of the year. Okay, so even if you have a college-age student, they're your dependent, they would not qualify for the child tax credit because most likely they're over the age of 17. Now, this is a partially refundable credit. And if you're not familiar with refundable credits or non-refundable credits, I encourage you to watch my other video I did where I go through in-depth detail on what is the difference between a refundable credit and a non-refundable credit. Now, the other checkbox, credit for other dependents, is a non-refundable tax credit for up to $500 for each qualifying dependent who doesn't meet the requirements for the child tax credit. So this would be children who are 17 or older, such as a child going to college because they're over 17. It could be an elderly parent or any other relative you support who may live with you and meets the IRS dependency rules. Okay, now that we've gone through the basic information such as your name, your address, and your dependents, now let's go to the meat of the 1040, which is all of your income sources. Like I said earlier, this is where we list all of the income sources from every different category you have, and you would list them here, and then it would show your total income. So I'm not going to go through each one of these different income sources, but I'm going to go over the most common ones. And we'll start off with the most common one, which is W-2 income or wage income. This is income you earn from wages as an employee. So if you have multiple jobs, you're going to get a W-2 for each of those jobs that you have. And the sum of all those W-2s you have are going to go on this first line right here. So if you have 4 different jobs, you get 4 different W-2s. They're not all going to be listed here, but the sum of those W-2s is going to be listed here, all right? Like I said, I'm not going to go through each one of these different income categories, but I'm going to go to the major ones. The other major one is interest income. This is interest income that you earn on either savings account or tax-exempt interest you earn from municipal bonds or treasuries, and it's reported to you on what's called a Form 1099 INT. Again, you would list all those different incomes you receive interest income, and the sum of that interest income will go on this line right here, which is line 2. Okay, and it's separated out by tax-exempt interest and taxable interest. So anything that you receive from municipal bonds or treasuries would go under tax-exempt interest. Anything that is from a regular savings account in a bank, they would go under the taxable portion. And depending on what type of tax-exempt interest it is, the sum will be added on to line 2B. The next category of income is dividend income, and that's going to be reported to you on a 1099 DIV. And it could either be qualified income or it could be it could be either qualified dividends or it could be non-qualified dividends. Now, qualified dividends are taxed at a lower tax rate because they meet certain IRS requirements, and non-qualified dividends are taxed at a higher rate, such as your ordinary income tax rate. If you want a more detailed explanation of the difference between qualified dividends and non-qualified dividends, I highly recommend you look at the video I did where I dig deeper into the differences between the 2 types of dividends. The next category of income is going to be IRA distributions. So IRA distributions are reported on Form 1099-R. The sum of all of your IRA distributions are reported on this line. So even if you have multiple IRA distributions, you're going to take the sum of all those IRA distributions and you're going to put the total amount here. Sometimes people roll over they change jobs, they have an old 401k, and they roll over that old 401k into an IRA. And even though that rollover is not taxable, they're going to get a 1099-R that's going to show that that rollover occurred, that that distribution occurred. So you have to report that 1099-R here to show how much was dispersed to you, but because it was rolled over, it's not going to be taxable to you. So you still have to report it, even though there's no tax implication for you on that rollover. So that's really important because you don't want to avoid excluding that 1099-R and then get a nasty letter from the IRS saying why you did not report that. The next category of income are pensions and annuities. This is income that most people get who are usually in retirement. So this is pension income either from a city or a government, maybe an annuity payment from an insurance contract. But this also includes distributions you get from a 401k, a 403b, or a 457 during retirement. So let's assume you did not roll over your 401k when you left your job and you retired, and now you're getting money from that 401k. That distribution is going to be classified here as pensions and annuities distributions, and it's also taxable to you. The next category, Social Security benefits, is pretty self-explanatory. This is where you're going to put all of your Social Security benefits. And if you and your spouse are both receiving Social Security, it's going to be the sum of both of your Social Security benefits. It's important to note that not all Social Security benefits is taxable depending on your income. So between 50 and 85% of your Social Security benefits may be taxable depending on how much money you earn. Right now, there's a lot of talk in the Trump administration and government about eliminating entirely the taxation of Social Security benefits. But for the time being, they're taxable, or for some people, all of it's taxable. For some people, only a portion of it's taxable. But for the time being, it has to be reported on your 1040. Now let's go to the other income category, which is capital gain or loss. And you'll notice it says attached Schedule D. So capital gains and losses are the result of selling a capital asset. A capital asset is things like a stock, bonds, real estate, collectibles, any like digital assets, etc. So for example, if you bought Tesla stock for $1,000 and then you sold it for $10,000, you have a $9,000 gain on that sale. That gain is a capital gain, and you have to report it on your tax return and pay tax on it. And the way you do that is you report it on the Schedule D. So on Schedule D, you're going to report all the different assets you sold. Sometimes you sell things at a gain, sometimes you sell things at a loss, but then you sum up all those gains and losses. You have that summation on Schedule D, and then from Schedule D, it flows into your Schedule 1040, which is what we're going over today. It's important to note that not all capital gains are taxed the same. For example, short-term capital gains, which are assets that you've held for less than 1 year, are taxed as if you earned ordinary income, like wage income. But long-term capital gains, which are assets that you've held for more than a year, so if you held that Tesla stock for 5 years, that's a long-term capital gain. And long-term capital gains have more favorable tax treatment. In fact, the maximum tax rate right now on long-term capital gains is 20%. The taxation of capital gains and losses is really complicated, actually, because some losses are not fully deductible, and you have a choice of which assets you can sell to generate or gain a loss. But for this conversation today, it's important to note that the sum of all of your capital gains flows into your 1040. And if you have gains, you have to pay tax on those. If you have losses, again, it becomes a little more complicated, but for most people, if they've got gains, they have to report it here and pay tax on those gains. So the next category of income we want to go over are additional income from Schedule 1. And as I mentioned earlier, the 1040 is a summation of all your different sources of income from different schedules and different forms. So in this case, we're taking something from Schedule 1 that's going to have different types of income, and then we're going to bring it forth here onto the 1040. So if we go to Schedule 1, we'll see that we have all these different types of income, additional sources of income that were not already captured on the 1040. For example, we have taxable refunds and credits, state income tax refunds, alimony received. But the areas that I want to focus on today are business income from Schedule C, right here, line 3, and also rental income, royalties and partnerships and S corps, because these are common types of business incomes that people receive in the US. So let's go over first Schedule C. Schedule C is primarily for sole proprietors that have income. So for example, let's assume that you have a regular day job, you get a W-2, and as a side business, you are also a realtor. You sell real estate, but it's not your primary job. And your spouse also has a side business by selling things on Etsy. So you're both considered sole proprietors. Each one of you will have income associated with your businesses, and you'll also have expenses associated with your businesses. And each one of you will list that income and expenses with your businesses on your separate Schedule C. So each one of you will complete the Schedule C. You'll have your income from your business, your expenses with that business, and it'll have a net profit. And then let's assume you have a net profit of $10,000 from the real estate that you've sold, and your spouse has a net profit of $5,000 from things that they've sold on Etsy. So together it's $15,000. That $15,000 would go on line 3 because it's a sum of all of your sole proprietor income that you received on Schedule C. Now, if you have 10 side businesses, each one's different, and you have 10 different Schedule Cs, all 10 of those would sum to put on line number 3. Okay. The next category of income, and as I said earlier, I'm only going to focus on the main types of income categories. I know some people get farm income, some people have unemployment compensation, or gambling compensation. I'm not going to go over those things. I'm going to go over the ones that are the most common for a lot of people. And having a side business being a sole proprietor is a form of common income that a lot of people receive. Now let's go over the rental real estate, royalties, partnerships, S corporations. So rental income, real estate rental income is also a very popular type of income that a lot of people receive. And let's assume that you have 2 rental properties, and in these 2 rental properties, you're going to report them separately, as you see on Schedule E right here. Just like we did for Schedule C for sole proprietor income, we're going to report all rental real estate, partnerships, and S corporations on a separate schedule called Schedule E. So let's assume you have these 2 rental properties. You're going to list each one of them separately. So each property is going to have its own rental income. Each property is going to have its own expenses associated with it. And then each property is going to have a net profit. So let's assume you have one property that's got a net profit of $50,000. And then you had another rental property that's got a net loss of $40,000. So together, if you combine them, you have a net income of $10,000. Remember, one has a net profit of $50,000, the other has a net loss of $40,000. So combined, it's $10,000 of net profit. If you only had the rental income, you would attach Schedule C showing those 2 rental properties, and then you would put that $10,000 here, okay, as your rental income. And then this would get flowed up to your 1040, and it would be added on to your interest income. It would get added on to your wage income and any other income you have, any other income sources. Some people also invest in partnerships. And if you invest in a partnership, usually they invest in partnerships to hold real estate. So you may be invested in a partnership with a few other people, and that partnership collectively owns real estate. In that scenario, the partnership files its own tax return. And when it files its own tax return, it gives you this form called a K-1. And on that K-1, it shows you your portion of the partnership's income or losses. So if there's a partnership, you're in a partnership and there's 3 other partners, so there's 4 of you total. Each one of you have 25% interest in that partnership. If that partnership had a rental property and the net profit of that rental property was $100,000, your K-1 would show that you have $25,000 of partnership income because you own 25% of that partnership, right? So you'd get your K-1, it would show $25,000, and that too would go on this line 5 right here that would show all of your partnership income. Another common type of income for business owners are S corporations. S corporations are super popular among small business owners because they offer a lot of the benefits of a traditional corporation like a C Corp, but the biggest benefit of an S corporation, among other things, is it does not have double taxation. Now, I'm going to do a separate video going really deep into S corporations, but for the time being, assume that you have an S corporation, it's not subject to double taxation. In that scenario, just like in a partnership, the S corporation itself files its own tax return, and then it gives all of its owners a K-1, just like a partnership does. And you're going to take that K-1 that shows what your income is from that S corporation, and you're also going to put it on line 5 here. So if you've got 2 S corporations that you've invested in, you've got 2 partnerships that you've invested in, and you've also got a side business, selling real estate, all those income sources would get combined and put into line number 3 and line number 5. Okay. Once you've got all that income, you're going to sum it here on Schedule 1. All the different sources of additional income, they're going to get summed here. And you'll see it says now you're going to enter it here and on Form 1040. So now let's go to the 1040 and see where we're going to put that number. Okay, so we're back on the 1040 and we see that on line 8, it's going to show all the additional income from Schedule 1. This is the sum of all your sole proprietor income. If you're a realtor and you sold things on Etsy, you had an interest in a partnership, you had interest in an S corporation, all that is going to sum and be totaled and put on this line item number 8. Okay. The next category is your total income. So this is going to sum all of your income that we just went over. It's going to have your W-2 income, any interest income, any dividends you received, any IRA distributions, Social Security income, capital gains from things that you've sold, K-1s from partnerships and S corporations or side hustles. All that stuff is going to be summed up right here to get to your total income on line number 9. Now, this total income is before any type of adjustments and deductions to your income. Once you have your total income, the next thing that happens is we go to adjustments to your total income. And we go back to Schedule 1 to list out all the different adjustments that may be applied to offset your total income. So here we are on Schedule 1. You'll see this is the first page of Schedule 1, which is the additional income that we just went over. But on the next page of Schedule 1 is the adjustments to income. And common adjustments to income include things like educator expenses, health savings accounts, moving expenses, deductible parts of self-employment tax, any pension plan contributions, self-employed healthcare deductions, alimony paid. As you can see, there's a lot of different types of adjustments to income that are going to get listed here. And you're going to sum up all those adjustments to income right here. You're going to enter it here on this line number 26, and you're going to enter it here on, you'll see it says on your 1040. So now let's go back to the 1040. So here we are back on the 1040. You're going to put here the sum of all those adjustments to income. So let's assume you contributed to an IRA, you contributed to a health savings account, you made a pension contribution from your real estate activities. The sum of all those things are going to go here on line 10. And then you're going to subtract line 10 from line 9 to get your adjusted gross income. The adjusted gross income is a very commonly used measure of income because it's widely used to determine eligibility for certain tax credits, such as a child tax credit or IRA income eligibility. But it's also used very commonly for mortgages. So when you're trying to apply for a loan to refinance a house or to buy a new house, they're going to look at your AGI to see how much income you have and how much you're capable of making those payments. Now, after the adjusted gross income is this thing called standard deduction or itemized deduction. And you'll see it says from Schedule A. The standard deduction is a fixed dollar amount that reduces your taxable income automatically. So whether if you're married filing jointly, single, you'll see on the left here, you get a standard deduction. If you're married or if you're single or married filing separately, your standard deduction as of 2024 is $14,600. If you're married filing jointly or if you're a qualifying surviving spouse, it's $29,200. and $21,900 if you're head of household. So you get that regardless. However, if you own a home and you do what's called itemized deductions, those are going to go on Schedule A. And if your itemized deductions are greater than your standard deduction, you can choose, which most people do, to go with the higher itemized deduction. And itemized deductions are things like your mortgage interest, your property taxes, your charitable donations, some healthcare expenses. So you sum up all those with some limitations on Schedule A. You'll see you do it separately on a different schedule. And then you put the higher amount of your itemized deductions or your standard deduction. So for example, if you were married filing jointly and your standard deduction is $29,200, and you had eligible mortgage interest of $50,000. Well, your $50,000 is greater than this $29,200. You would put that $50,000 here under line 12. Okay. So once you've got your itemized or standard deduction, the next category is called the qualified business income deduction, also known as a QBI deduction. The QBI is the result of the Tax Cuts and Jobs Act of 2017, and it was introduced by then President Donald Trump in 2017. In short, the QBI deduction is a very generous 20% deduction against your AGI, and it's calculated based on the business income you have. So remember earlier I mentioned if you have income in a partnership, a sole proprietorship, or an S corporation. Well, let's assume you have just one investment in an S corporation and your net profit from that S corporation is $100,000. Well, in its simplest form, the QBI deduction gives you an automatic $20,000 deduction against that $100,000. So when we're calculating your taxable income, we're essentially subtracting out that generous $20,000 from all of your income sources to reduce your tax liability. So it's a very generous deduction. In fact, I did a very detailed video of what is the QBI deduction and how it's calculated, because it's not as straightforward as I just explained. It's got a lot of nuances to it, and there's also eligibility requirements for it. And if you're interested, go look at that video because it will give you more detail on who qualifies for the QBI deduction. Okay, now that we have the QBI deduction, we're going to add up all the different income sources, and which would be your AGI. We're going to subtract out the qualified business income deduction, and it's going to give you your taxable income. Now, the taxable income is what's used to calculate how much tax that you're owed. So if you notice, we're already at the bottom of the page for the 1040, because the first page of the 1040 is essentially the calculation of all of your income that we just went over. We subtract out the standard or itemized deduction. We subtract out the qualified business income deduction. And then once we've done that, now we're left with the taxable income, how your tax is determined based on what type of income. Now that we know your taxable income, it's time to go to the second page of the 1040, where we go over what your actual tax is based on that taxable income. Okay. And it's a building block of taxes. So first we calculate what the tax you owe is based on your taxable income. And then we add additional other taxes based on other criteria. And when I say other criteria, we're looking at, again, another schedule. So here you'll see it says other taxes from Schedule 2. So let's go to Schedule 2 and see what those other taxes may be. So now we're in Schedule 2, and we're seeing that additional other taxes are self-employment taxes, Social Security and Medicare taxes on unreported tip income, household employee taxes, additional Medicare tax, net investment income tax. You'll see there's all these different types of other taxes that have to be added on to your regular tax that's based off of a tax schedule. So once we've got all that, we sum the total taxes owed of other taxes. We get the total of other taxes. We enter them here on line 21, and we enter them again on the 1040. So now let's go back to the 1040. Okay, we're now back at the 1040. We'll see that on the taxes, we got the regular tax that was based off your taxable income that we just calculated above right here. Then we have the additional taxes such as self-employment taxes, payroll taxes, additional Medicare taxes, additional net investment income taxes. So we add those all up, and any other credits or taxes, as you'll see here, we add them all up, and it comes to our total tax, the total tax owed on line 24. It's going to come here. Now that we know the total tax owed, the next step is to see how much payments you've made for that tax. So let's assume your total tax owed is $50,000. We want to see how much payments you've made against that $50,000 throughout the year. The U.S. operates under what's known as a pay-as-you-go tax system. What that means is taxpayers are required to pay income taxes throughout the year as they earn money and they receive income. And they pay those taxes either through withholdings from paychecks or through estimated tax payments. And we're going to go over those payment types here. So the first line is federal income tax withheld from W-2s or 1099s. If you have a regular day job and you have a W-2, you'll notice that when you get your paycheck, a portion of that paycheck is withheld for both federal taxes and state taxes. And you are the one that determines how much is withheld. You can withhold a lot for taxes, or you can withhold very little for taxes. And whatever you withheld will be listed here for the total year. So for example, if your wages for the year was $100,000 and you decided you want to withhold $25,000 of federal taxes, that's how much will be shown here based on your W-2. Now, if your tax liability was $30,000 and you only withheld $25,000, you're going to owe some money. But if your tax liability up here was $20,000 and you only withheld $25,000, now that means you're going to get a refund, right? So let's put in some numbers here. Let's assume your tax liability is $25,000, okay? And from your paycheck, you had only $10,000 withheld of federal income tax. All else being equal, you've under withheld taxes because based on all of your income, you owe $25,000, but in your paycheck, you only withheld $10,000. That means you still owe $15,000, right? Now let's assume of all your sources of income, you also had some IRA income. And from that IRA income, you had taxes withheld of another $10,000. Well, that means now you withheld $20,000 against your $25,000 total tax liability, which means you still owe another $5,000. Throughout the year, you have the option of making estimated tax payments during the year, and you make them on a quarterly basis based on, as I said, pay-as-you-go system. So if you earned a lot of money in the beginning of the year, then the expectation is that you're going to pay estimated taxes in the beginning of the year to pay for that income that you've earned. So let's assume during a year you made another $10,000 of estimated tax payments. So your total tax payments that you made was $30,000. $10,000 from your W-2, $10,000 withheld from your IRAs, and then you also made a separate $10,000 payment as an estimated tax payment, so $30,000 total. Well, now that means you have a $5,000 refund because your tax liability was $25,000, but the total taxes you paid during the year was $30,000. So you've got an overpayment of $5,000. If your tax liability right here was $35,000, well, you'd have a tax owed of $5,000 and not have a tax refund because your tax liability was more than what you had withheld or paid in estimated tax payments. Let's go with the first scenario, assuming your tax liability was $25,000 and you're entitled to a $5,000 refund. Okay, so we have a $5,000 refund based on $25,000 of tax owed. You have the choice of either getting a paper check for that refund of $5,000, which very few people do, and it's also risky to do that because that paper check can get lost or it could get stolen by someone else and cashed. The best option to do is to do a refund to you, a direct deposit. You can either directly deposit into your checking account or your savings account. You'll have to put in your routing number and your account number, and that's the fastest way of getting your direct deposit. The other option you have is, let's assume, see how you made estimated tax payments of $10,000 this year? That means that your withholdings are not enough to pay your tax. And if you want to minimize that for the following year, you can say, instead of getting that $5,000 back in my checking account, I'm just going to go ahead and apply that for the following year because I know already I'm going to have to pay that anyway. So why not just apply it for the following year? So then this basically means your overpayment of $5,000 that you're supposed to get as a refund, you've decided to just apply it to the following year, right? So now you neither have a refund nor do you have a tax amount due. Now that we know the refund and the amount owed and how that's captured and how to handle that, let's go to the third-party designee section. Okay, so the third-party designee section is a way for you to allow the taxpayer to authorize someone else, like either a tax preparer, a family member, other financial professional, to discuss your tax return with the IRS after it's been filed. Now, this person can answer questions about your return, they can provide any missing information, and they can receive and respond to IRS notices. And they do that by you putting their name on there and a 5-digit PIN that you choose that they're going to that this third-party designee is going to provide to the IRS when they call and want to talk about your tax return. So, for example, if the third-party designee is John Doe, and you put their phone number here, and then you identify a PIN 1, 2, 3, 4. Let's see, 3, 4, 5. You identify this PIN. When John Doe calls the IRS to ask questions about your tax return, they're going to use this PIN to identify themselves. It's important to note that this is not a power of attorney. So a power of attorney is very, very different than a third-party designee. One way that it's different is the authorization is only limited to the current tax year, and it does not give a power of attorney. So it just gives permission to talk about this tax return and nothing else. So this is how you complete a Form 1040. I hope that it was helpful for you. Obviously, you have to sign your tax return and date it and put your occupation. And if you have a paid preparer, you'd have to put their name in. They would fill out that part. But hopefully you found this video helpful. If you did, please remember to subscribe, like, and share our channel. And if there's a topic that you want us to cover, or if there's something you want us to elaborate on, please leave it in the comment section, and I'll make sure to do another video that's specific to that topic or to answer that question.